Right now we continue statement of cash flows LKAS 7. Today's focus area is reporting the cash flows and other disclosures according to the LKAS 7. So it's a second session about LKAS 7. So as you aware that the presentation of cash flow, there are mainly three components in the statement. So first one is operating activities, cash flows from operating activities, and cash flow from investing activities, and cash flow from financing activities. So operating activities focus basically the day-to-day operations, the main operations, so from which the entity's profit and losses are determined generally. So investing activities, it's apart from their day-to-day businesses, their normal operations, they may find other avenues to make money. It includes investment in long-term assets, property, plant, equipment, purchasing on PPE, and selling of PPE, and investing money or investing on equities of other companies. Like that, we have discussed some more examples in the yesterday's session. And financing activities includes the ways of getting money for the entity. So it may be in the form of a new share capital, new issue of equity shares, and borrowing from banks, like that. And also it includes dividend. Sometimes the dividend may include in the operating activities, but it's common. So it's a cost in the when we see the dividend payment on equity shares as a cost to the financing, so it can be justified in that way, then we can include that in the financing activities. And redemption of shares, that's also will be included in the financing activities. And settlement of loan will be included in financing activities. And what about the interest payment? So where we have to include that interest cost, whether it's operating activities or financing activities. Interest payment, any suggestions? Interest payment, operating activities, right? Good. So here in the way of presenting the cash flow statement, particularly operating activities, so it can be present in two ways. One is direct method and indirect method. So direct method focus on, it's very obvious, right? Basically it will give the ability to make money through its operations, right? So how much amount of money received from sales, how much amount of money paid to suppliers, how much paid for salaries, paid as salaries to employees, and other expenses may include. So that is in direct method. And indirect method, it's a kind of adjustment of net profit. Sometimes it take a profit before tax, sometimes it takes a profit before interest and tax. And it makes some adjustments for non-cash flow activities, and there's some make adjustment on working capital. So increment in working capital. So changes in inventory, changes in receivable, changes in payable, like that. So that kind of adjustments we have to make to adjust the net profit before tax, or profit EBIT. So it's based on the situations. As LKAS 7 give options, either the entity can disclose their statement in direct method or indirect method, but many investors expect direct methods as a preferred method. So it's very easy to understand to assess the ability of making money. An entity presents its cash flows from operating, investing, and financing activities in a manner which is most appropriate to its business. So the categorization of its presentation of cash flows under these three categories is based on appropriate classifications, appropriate justifications, right? So the classification by activity, classification mean like this, operating, whether it's operating activity or investing activity or financing activity. Classification by activity provides information that allows users to assess the impact of these activities on the financial position of the entity and the amount of its cash and cash equivalents. So when you look at the balance sheet, you can find the cash balance and equivalent balances like cash and cash at bank and short-term investments like that. And when the investor, when the user of the financial statement look at the figure in the balance sheet, the cash balance, so they couldn't get detailed information and unable to assess the capacity of the entity to make money. So therefore it's the cash flow statement, it's a special reference to assess the companies, the entities activities, so whether it's able to make more money on operations or whether the company makes money from investment activities and so on, and where the companies makes finds money, so it's particularly in financing activities. So this information may also be used to evaluate the relationship among those activities. So an entity shall report cash flows from operating activities and using either direct method or indirect method. So direct method whereby a major classification of gross cash receipts and gross cash payments are disclosed. So when you look at the cash flow statement in the direct method, it shows obviously shows how the company get fund, sales collection from customers due to the sales or the payment to its suppliers, so when they purchase raw material or other related things. So that is our direct method, whereby major classification of gross cash receipts and gross payments are disclosed. And the indirect method here, whereby a profit or loss is adjusted. So we it's kind of reconciliation statement. So we reconcile the profit into cash movement, right? So we adjust the profit balance into cash balance. So it's cash balance mean, so how much cash generated from the operating activities of the entity. So whereby profit or loss is adjusted for the effect of transactions and non-cash nature. And also not only the transactions, and in the indirect method you have to make adjustment for non-cash natures like depreciation, accruals and such things. Any deferral or accruals, so here the accrual method, accrual basis of accounting we are following. So deferral, so it's mean what, payments are postponed and receivables are postponed, like that, of past or future operating cash receipts and payments, and the item of income or expense associated with investing or financing cash flows. But the investing and financing cash flows, there is no difference between direct method and indirect method. So these the differences you can find under the operating activities only, right? So it's make adjustment on profit. Reporting cash flows from operating activities. First we look at the direct method. Entities are encouraged to report cash flows from operating activities using direct methods. So LKAS allows and encourage to prepare the cash flow statement on direct method. The direct method provides information which may be useful in estimating future cash flows and which is not available under indirect method. So when you look at the cash flow statement which is prepared using direct method, so it gives more detailed information to the decision maker or the user of the financial statement. So they can observe, they can assess the ability of making money by the entity. So they look at how much amount of money received from sales, how much amount of money paid to its suppliers, how much paid as salary, how much paid as wage, how much paid as interest expense and income taxes and other expenses. When you look at the indirect method, you couldn't find this kind of information. What they are doing is, in the indirect method, they are adjusting net profit with non-cash items and other relevant things and working capital adjustments. So direct methods give a comprehensive and detailed information to the users. And under the direct method, information about major classes of gross cash receipts and gross cash payments may be obtained, right? So here in the indirect method, they are not taking net, so they are getting what gross cash receipt and gross payments. So the amount of cash received and amount of cash paid, cash inflow and cash outflow from their day-to-day operating of the business, operation of the business. From the accounting records, right, use information about major classes of gross cash receipt and gross cash payments may be obtained either from the accounting records of the entity. When you look at their books, ledgers of the entity, you can find how the amount of the nature of cash flows. So you can find the sales book, or you can find purchase book, and you can find the bank statements. So from which you can find where the money comes from. And by adjusting sales, cost of sales, interest and similar income, so interest income and interest expenses and similar charges for financial institutions, and other items in the statement of comprehensive income. So we can find here the sales value and cost of sales, interest income, interest expenses and other similar charges, other finance cost. So these items we can find in the income statement. Changes during the period in inventories and operating receivables and payables, you can find changes during the period in inventories and operating receivables and payables. You can find this information from the balance sheet. And other non-cash items like provisions and provision for loss, provision for bad debt, provision for doubtful debt, and depreciation. So this kind of things. And other items for which the cash effect are investing or financing cash flows. So this is the typical statement of cash flows in direct method. So simply we start from how much amount of money received from customers, cash receipt from customers, and we deduct the cash paid to suppliers and employees. So X is a cash inflow and Y is a cash outflow, and cash generated from operations. So X, the Z equal X minus Y. So net cash flows, cash generated from operations, and this balance should be adjusted with interest paid and interest in income taxes paid. So LKAS 7 requires the interest payment and interest expenses should have a separate disclosure, so it's a separate item, right? So basically the Z value the cash generated from operations shows the efficiency. So here the interest payment is not depends on its financial operation, its business operations, but rather the interest payment it shows the indicator. It's an indicator of its financial leverage. If the entity obtained much amount of bank loan or borrowed fund, so they have to pay high interest. So it's a given idea about financial leverage and financial risk of in the entity in the way of interest paid. Actually, it's not an operations, rather it's kind of what interest expenses. So the interest expenses should paid from the income generated from the normal operations. So therefore it's deducted from operating activities, but actually it's a financing activity. So what's the reason behind? The interest paid by the entity, the amount of interest paid by the entity should be generated from operations, so we deduct that amount. And income tax paid, it depends on the policy of the government, and it's also if the firm earn more money, so they should pay high income taxes. So the income taxes normally charged on the income of the entity. So this income can be derived not only from the operation of the business, and it may come from investment activities also. But the problem here is the identification of the proportion of income tax, how much amount of tax belongs to the operating activities, how much amount of income tax for investment activities. So its identification is very difficult in practical. So therefore LKAS requires to deduct this the tax expenditure under the operating activities. So another justification is the income tax. The major source of income of the entity is its operations. So therefore the income tax consists the higher proportion from the operating activities. Therefore, and the income tax expenses also should be paid from cash generated from operations. So therefore, the cash generated from operations Z value should be deducted by A and B. So finally it will shows the net cash from operating activities. And we look at the Indirect method. Under the Indirect method, the net cash flow from operating activities is determined by adjusting profit. Here we look at here. So adjustment of profit or loss, right? Loss for the effect of, so what are the adjustments here to make on that? First adjustment is changes during the period in inventories and operating receivables and payables. So it's a working capital adjustments, and so we have to find the changes in inventories. So we have to take opening balance and closing balance, and we have to find the changes in inventories, changes in receivables, changes in payables. So we have to make adjustment. And non-cash items such as depreciation, provisions, deferred taxes, unrealized foreign currency gain and losses, and undistributed profit of associates. So these are the non-cash items. So even though in the income statement we show as the expenses, but actually these expenses are not in the form of cash. So we are preparing a cash flow statement. So we are not interested on the non-cash items are not impact on cash flows, but it may impact on profit. So therefore the profit is adjusted to find the actual cash flows, and all other items for which the cash effect are investing or financing cash flows. And it's normal practice when calculating in investment activities and financing activities. So regardless about the method, regardless of direct method or indirect method, there is no differences between in the classification and financing activities and the investment activities. So the adjustment makes only the operating activities. So this A and B will be considered. Alternatively, the net cash flow from operating activities may be presented under indirect method by showing the revenue and expenses disclosed in the statement of comprehensive income and the changes during the period in inventories and operating receivable and payable. So to prepare the cash flow statement using direct method, we want balances, opening balances and closing balances of inventories and receivables and payables. So such kind of information we can take from income statement, and cost of sales, that kind, and net profit, that kind of information can be taken from income statement. So this is the typical model template of preparing cash flow statement, especially centric method, right? So it start from profit before taxation. So we have to find the profit before taxation value, and it should be adjusted. Initially it should be adjusted, this profit should be adjusted for depreciation, foreign exchange losses, investment income and interest income. So actually it's what then when we make adjustment for this, it gives the figure profit before interest and tax, profit before interest, tax, amortization and depreciation. So we can get this value when we adjust this figure by this value. So this value equal to what? This value equal to profit before interest, profit before tax, interest, amortization and depreciation. So most of the time maybe it's equal to that, and we have to make adjustment for working capitals. So movement, whether it may be increase or decreases in trade and other receivables, and movement in trade payable and movement in inventories. Here R represent receivable, P represent payable, I represent interest. So this balance will be equal to the net of this balance will be equal to the working capital adjustments, changes, and from which we can find the cash generated from operations. Here this value, and interest paid and income tax paid, as we did in their direct methods. So finally we get deduct cash from operating activities. So it's a kind of reconciliation statement. We reconcile the profit before taxation figure into cash figure. So for which we have to make this kind of adjustments. And reporting cash flows on net basis. So earlier we talked about on gross basis, right? Gross. Here reporting cash flows on net basis. Gain minus loss equal profit. The profit value is the net. So like that, for example, cash flows arising from the following operating, investing or finance activities may be reported on net basis. It's not compulsory, it's may be reported on a net basis. For example, for the condition, so for the instances here, case receipts and payment on behalf of a customer. So case receipt or case payment on behalf of the customer when the case flows reflect the activities of the customer rather than those of entities. So here the entity is not a matter, the activity is the matter. So how much amount received, how much amount paid. So no matter from which customer, the activity is important. The acceptance and repayment of demand deposit of a bank, so we can disclose what the balance figure, balance, and fund held, so net figure, right? The fund held for customers by investment entity and rent collected on behalf of and paid over to the owner of the properties. So we can put the net value. And second, the B, the case receipt and payments for items in which the turnover is quick and the amount are large and the maturities are short. For example, advances made for and repayment of principal amount relating to the credit card customers, the purchase and sale of investments and other short-term borrowings. For example, those which have a maturity period of 3 months or less, it's a cash equivalent. Cash flows are arising from each of the following activities of financial institutions, not for the manufacturing or other institution. Here they clearly mention it's relevant to financial institutions like bank and the insurance companies. So cash flow arising from each of the following activities of financial institutions may be reported on net basis. So case receipt and payment for the acceptance and repayment of deposit with the fixed maturity date. So no need to record by day. So how much we told, deposit we told, deposit we told. No need to record here. So we can the institution can record the net figure. The replacement of deposits and withdrawal of deposits from other financial institutions. So it's the same thing, right? Case deposited, withdrawed, deposited, withdrawed. So these things. So no need to disclose each and every transaction, but we can take it as a net value. And case advances and loans made to customers and repayment of those advances and losses. It's particularly bank loans and advances means what? Advances mean loan. So another synonym is for the loan. Foreign currency cash flows. When a company, when an entity dealing with foreign exchange, foreign tradings, it make payments on foreign currencies, say US dollar, or the company may receive income in other currencies. So that also the cash flow, right? That also is a cash flow. Then how to deal, how LKAS 7 deal this kind of situations, foreign currency cash flows. So it is very important to understand what is foreign currency and what is functional currency. So we will discuss in detail in forthcoming chapter, that's LKAS 21. So we will discuss in detail, right? The cash flows arising from the transactions in foreign currency shall be recorded in entity's functional currency by applying to the foreign currency amount the exchange rate between the functional currency and the foreign currency at the date of the cash flows. Normally what they do is when the transaction occurs, if the transaction occurred in foreign currency, the value of transaction will be converted into the local currency, that is functional currency of the entity. Say in Sri Lankan point of view, if an entity exports something to US, the entity receive income in foreign currency, US dollar. So this US dollar value of foreign currency will be converted into local currency. Sri Lankan rupees may be local currency. So local currencies may be here it's a functional currency, right? Here the cash flows arising from transaction in a foreign currency shall be recorded in entity's functional currency. Say in Sri Lanka, a functional currency is Sri Lankan rupees. The functional currency and domestic currency are not same all the times. Very careful about that, so we will discuss in detail in forthcoming chapter. So by applying to the foreign currency amount the exchange rate between the functional currency and foreign currency at the date of cash flow, very important, the date of the cash flow. So when they receive the money, that time they have to take the real exchange, the exchange rate on that date, not at year end. The cash flows of foreign subsidiary shall be translated at the exchange rate between functional currency and foreign currency at the date of cash flows. And here it's not a transaction, so one subsidiary, right? One subsidiary, a subsidiary wanted to convert their cash flows on their parent company's currency. So it's a different situation. So the cash flow of foreign subsidiary shall be translated at the exchange rate between the functional currency and the foreign currency at the dates of cash flows. Right? The same thing here. It's about the first point deal about transactions. The second point is deal about translation. Right? Translation. You might study about translation risk under the foreign exchange risk. And the cash flows denominated in foreign currency are reported in the manner consistent with LKAS 21, that is the effect of changes in foreign exchange rate. So this permits the use of an exchange rate that approximate the actual rate. This permit the use of the exchange rate approximate the actual rate. For example, weighted average exchange rate for period may be used for recording foreign currency transactions or translations of cash flows of the foreign subsidiary. However, LKAS 21 does not permit use of the exchange rate at the end of the reporting period, which translating the cash flows of foreign subsidiary, right? So the LKAS 21 restricts to use of the translating the foreign currency to functional currency and based on the exchange rate at end of the reporting period. Rather, it should be translated. It should be translated based on their exchange rate at the date of the transactions, not at the end of the reporting period. Unrealized gain and losses arising from changes in foreign currency exchange rates are not a cash flows, right? So due to the fluctuation in the exchange rate, so it may sometime give profit, sometime loss. It's a foreign exchange gain, so it's not a cash movement. These losses and gains are not a cash movement actually. However, the effect of exchange rate changes on cash and cash equivalent held due in foreign currency is reported in the statement of cash flows in order to reconcile the cash and cash equivalent at the beginning and end of the period. Anyhow, even though it's not a cash, but it may impact on amount payable or amount receivable. So it may arise as issues when they are reconciling the cash book. So this amount is presented separately from cash flows from operating, investment and finance activities and includes the difference, if any, had those cash flows been reported at the end of reported period. So in these circumstances we can find additional information. So the foreign exchange related things you can find in the cash flow statement separately. So it not included in those three, that is not operating, not financing, not investing. So it will be disclosed separately. And how to deal with interest and dividends. The cash flows from interest and dividends received and paid. Here the cash flow from interest, dividend received and paid. It may be in the form of interest income. So an entity make investment or make money, so deposit money in the bank, then it will receive interest. If the entity obtain loan, then the entity will pay interest. And if the entity invest in other entity shares, it will give dividend, and sometime it pay dividend to its shareholders. So cash flows from interest and dividends received and paid shall each be disclosed separately. Each shall be classified in consistent manner from period to period as either operating, investing and financing activities. The total amount of interest paid during a period is disclosed in the statement of cash flows whether it has been recognized as an expense in profit loss or capitalization in accordance with LKAS 23. So you might study about LKAS 3 borrowing cost. There are two options there. So you can capitalize the interest cost, or you can show as an expenditure, interest expenditure. So based on that, the decision, the policy, you have to incorporate that in the cash flow statement. So you should follow consistency of policies. Interest paid and dividend received are usually classified as operating cash flows for financial institutions. When you take a bank, so interest expenses and interest income both are not investment activities or not financial activities. So these are the normal operations. So therefore it should categorized under the operating activities. Here it's clearly defined, what clearly explains each shall be. Each mean what? Interest paid and interest received, dividend paid and dividend received. So each shall be classified in a consistent manner. Consistent manner mean, so they have to follow consistency of policy. It means in the previous year the dividend or interest payment, so the dividend disclosed in the investment activities, and this year also they have to show in the investment activities. If they shown last year under the finance activities, so this year they also should disclose under finance activities. So this is the consistency. So there should be no change over the period. So the each shall be classified in consistent manner from period to period as either operating, investing and financing activities. However, there is no consensus on classification of these cash flows for other entities. So interest paid and interest and dividend received may be classified as operating cash flows because they enter determination of profit or loss. Sometimes some firms may disclose the interest paid and interest and dividend received as its operation. and because they think that it's contribute significantly every year in making money, in making operating profit. So therefore they have classified under the operating activities, and some entities may classify it as investment activities, interest income received or dividend received, investment activities. So there's no consensus regarding that, regarding interest and dividend, interest income and dividend income. Alternatively, interest paid and interest and dividend received may be classified as financing cash flows and investing cash flows respectively. Here, interest expenditure can be classified as financing activity, and dividend and interest received as investing activities, right? Because they are cost of obtaining financial resources or return on investment. When you look at the interest paid, it's a financing cost, therefore it should be categorized under the financing activities. This is one argument. And interest income and dividend income, so this is what it's a return on the investments, so therefore they can classify it under the investment activities. Or if the entity have strong justification, they can include in their operating activities, no matter, right? So therefore there is no consensus on the classification of these classifications regarding this one only, right? Interest and dividend, not all the things. So dividend paid may be classified as financing cash flows because they are a cost of obtaining financial resources. Dividend paid, so it's a cost. Dividend paid may be classified as financing cash flow because they are cost of obtaining financial resources. Alternatively, dividend paid may be classified as a component of cash flow from operating activities in order to assist user to determine the ability of entity to pay dividend out of the operating cash flows. So this dividend payment also may include in the operating activities. So it's based on the arguments. Tax on income, income tax. So as we discussed earlier, normally income taxes are disclosed, classified under the operating activities, but the argument here is the income may generate not only from operating activities, the income may be generated from investment activities too. So even though we are disclosing under the operating activities, cash flow arising from taxes on income tax shall be separately disclosed and shall be classified as cash flow from operating activities unless they can be separately identified. It's very important, separately identified with financing and investing activities. So if the entity is unable to separately identify tax on income, and it should be disclosed under the operating activities. Taxes on income arises on transactions that give rise to cash flows, right? So normally income tax charged on their income, so inflows, give rise in. So taxes on income arise on transactions that give rise to cash flow. It means profit. So the taxes will be charged on the profit that are classified as operating, investing or financing activities in a statement of cash flows, while tax expense may be readily identifiable with investing or financing activities. The related tax cash flow are often impracticable to identify and may arise in a different period from the cash flows of the underlying transactions. So therefore taxes paid are usually classified as cash flow from operating activities. However, when it is practicable to identify the tax cash flow with an individual transaction that give rise to cash flow that are classified as investing or financing activities, the tax cash flow is classified as an investing or finance activity as appropriate. So here what they are emphasizing is if an entity is correctly identified how much amount of income is derived from operations and how much the income tax on that income, and how much income received from investment activities and how much amount of tax on that investment activities, how much amount of income received from investment finance activities, how much amount of tax on that income on that activities. So if they identified easily, then they can deduct the interest expenses accordingly. But in practical, it is impossible. It is very difficult to identify. It's very difficult to identify separately. So therefore, it's a common decision is the income tax expenses will be disclosed under the operating expenses, under the operating activities. Here, investment in subsidiaries, joint subsidiaries, associate and joint ventures normally is coming under investment activities, investment in subsidiaries, associate and joint ventures. When accounting for investment in associates or subsidiary accounted for by use of the equity or cost method, an investor restricts its reporting in the statement of cash flows to the cash flows between itself and the investee, for example, dividend and advances. An entity which reports its interest means its stakes, its ownership in jointly controlled entity using proportionate consolidation includes its consolidated statement of cash flows, its proportionate share of the jointly controlled entity and its cash flows. An entity which reports such an interest using equity method includes it in its statement of cash flows the cash flows in respect of its investment in jointly controlled entity and distributions and other payment or receipt between jointly controlled. So it's you can read and understand, right? It's not much important, the slides. And also changes in ownership of interest in the subsidiaries of the business, so you can go through and you can understand. And we look at the non-cash transactions. So investing and financing transactions that do not procure the use of cash or cash equivalent shall be excluded from the statement of cash flows. Here we are preparing, entity is preparing cash flow statement where there is no space for non-cash transactions. So those activities should be excluded from the statement, from the cash flow statements. So such transactions shall be disclosed elsewhere in their finance statement in the way that provides all relevant information about these investing and financing activities. So there are many non-cash transactions, so that may not disclose in the cash flow statement. So the detail of that non-cash transaction, non-cash things can find in any elsewhere, or it means they can find information on income statement or the balance sheet. So many investing and financing activities do not have a direct impact. So it's regarding non-cash transaction, right? So many investing and financing activities do not have direct impact on current cash flows, although they do affect the capital and capital structure of the entity. The exclusion of non-cash transaction from the statement of cash flows is consistent with the objective of the statement of cash flows, as these items do not involve in cash flows in the current period. So exclusion of non-cash transaction is not contradicted with LKAS 7's objectives. So the objective is what? So wanted to disclose the cash movement. Examples of non-case transactions are the acquisition of assets either by assuming directly related liabilities by means of financing lease, the acquisition of an entity by means of equity shares so without paying money, just an entity issues equity shares to buy another company. So in this situation there is no cash movement, but it's a financing activity. So acquisition. So the third one, the conversion of debt to equity. So the company have lot of loan burden. So to resolve that, the company provides its ownership to the lenders instead of borrowing. And components of case and case equivalents. Here we have already discussed in what is cash and cash equivalent. Anyhow, we just go through that. An entity shall disclose the component of cash and cash equivalent and shall present a reconciliation of the amount in its statement of cash flows with the equivalent items reported in the statement of financial position. In view of variety of cash management practices, banking arrangement around the world, and in order to comply with LKAS 1 presentation of financial statement, an entity disclose the policy which it adopts determining the composition of cash and cash. So it's not things here. Other disclosures. An entity shall disclose together with commentary by management. Here there are some suggestions, opinions of management regarding the cash flows. So that should be disclosed in their financial statement. An entity shall disclose other with the commentary opinion by the management, and the amount of significant cash and cash equivalent balance held by the entity that are not available for use. So the money is available, cash and cash equivalent are available in the entity, but they are unable to use. They are unable to use the cash balances. There are some instances. In that instances, the management should give their commentary, their suggestion, their opinion regarding that at the time of unable to use the cases, even though they have enough cash balances. So there are various circumstances in which the cash and cash equivalent balances held by entity are not available used by the group. For example, include cash and cash equivalent balance held by subsidiary that operates in a country where exchange control or other legal transactions apply when the balances are not available for general use by their parent or other subsidiaries. Here, for example, American subsidiary is operating business in Sri Lanka, and the subsidiary has a lot of cash balances, but meanwhile the government has give restrictions on transferring the cash to US due to the foreign exchange control. So this time they have available cash balance, but they are unable to use. So this time the management should disclose this kind of instances. So other disclosures, so additional information may be relevant to the users in understanding the financial position and liquidity of an entity. So disclosure of this information together with commentary by management is encouraged by many, right? So there are some instances where the management should give their opinions. The amount undrawn borrowing facilities. So the banks give borrowing facilities. So bank already agreed to give some sort of loan to the company entity, but the entity does not utilize it. So in that time they have to disclose what's the reason. Management should disclose as a commentary the amount of undrawn borrowing facilities that may be available for future operating activities and to settle capital commitments, indicating any restrictions on the use of these facilities. The aggregate amount of cash flows from each of operating, investing, and financial activities related to interest in joint ventures reported using proportionate consolidation. The aggregate amount of cash flows that represent increase in operating capacity, right? Here they have cash, so the purpose is they're going to expand the operations of the entity. So that money should be disclosed separately. The aggregate amount of cash flows that represent increase in operating capacity separately from those cash flows that are required to maintain operating capacity. And the amount of cash flows arising from operating, investing and finance activities of each reportable segment. So you may study about segment report. And the disclosure here, the separate disclosure of cash flows that are represent increases in operating capacity and cash flows. My battery is out of, so now battery is out of power, so it's a final slide, so you can go through and you can find, right? So I'm very sorry that my laptop is out of charge. Okay, thank you very much. If you have any doubt, you can communicate with me later. Thank you very much.